As 2019 fades into history, we are in the longest U.S. economic expansion ever, and it looks well positioned to continue through 2020 and a year or two more years further just to add to its record-breaking streak. It has not been a spectacular economic expansion in real GDP terms, but the unemployment rate has declined to 50-year lows and remains comfortably under 4%, while inflation is only a touch below the Fed's target 2% rate. What could go wrong? Well, as many economists are fond of saying, including ourselves, economic expansions do not end from old age. It takes a major bump in the road, and usually that bump is rising short-term interest rates pushed on the economy by a Federal Reserve scared of future inflation. That is off the table this time around. The Fed has pegged its federal funds rate target to just below the prevailing inflation rate, a neutral policy stance. The trade tensions were a possible culprit, but the current ceasefire seems likely to hold for some time. At this point, the trigger is not clear, and that is good news. But we have to remember, a common characteristic of recessions is that they require a trigger, and the recession occurs because there's too much debt in some part of the economy. It's too early to identify that trigger, but it's not too early to worry about too much debt. Debt is expanding faster than growth prospects in virtually every sector of the U.S. economy and in many major countries around the world. What has been the driver of debt expansion? Well, very low interest rates, even negative ones in some parts of the world, have created a search for yield environment. And in a search for yield, whether equities, high-yield debt, subprime auto loans, mortgages, emerging market debt, whatever can lead the market participants to downplay risks and extend asset price rallies, that can eventually end in tears. At this point, though, we are seeing this as a risk, not as a likelihood. Yet we are also watchful of the central bank policies that have created the search for yield and may possibly be adding risk to a system that is slowly getting overextended, just not for 2020. I'm Blue Putnam, Chief Economist, CME Group.